Hey there, Mike and Jennifer. Thank you guys so much for joining me to tell me about this cool new loan program today. Good to see you guys.
Thanks for having us.
Yeah, perfect. Maybe just a quick intro of who you are, who you're with, what you do.
I'm Jen Castaneda with Supreme Lending, and our branch is located here in Pacifica. And we are home lending expert. We are specifically licensed in California, but at Supreme Lending, we can offer loans all throughout all 50 states. And today we will be talking about the new down payment assistance program that's called the California Dream for All.
And I'm Mike Ervin. I'm the branch manager here of the Pacifica branch. We also have, I think it's 7 branches throughout the Bay Area, San Mateo and across the Bay. I've been in the industry for over 30 years. And we're hopeful you'll find this presentation useful.
I see you have a nice presentation set up for us. Let's go ahead and jump right in.
This is the California Dream for All program. First thing you understand is that it is a down payment assistance program run by the state of California. And we'll just kind of go through the slides real quickly here. First of all, we're looking at just some of the basic information. They will provide up to 20% down payment towards the purchase of your home, and it would be towards the sales price or appraised value, whichever is lower. Again, it's an equity share program, so we'll go into more detail on how that works. A couple things to understand. First thing, it is a first-time home buyer program, although there are some workarounds to that, some exceptions to the rule. So if you haven't owned a home in over 3 years, you're considered a first-time home buyer. If you have like an investment property that you haven't lived in over 3 years, first-time home buyer. If you've co-signed with someone as long as you've never lived in that home, so let's say if some parents or somebody co-signed with them, you're considered a first-time home buyer.
Quick question as far as that works. Sorry, I'm going to interrupt a little bit. Just questions like situations that I can think of, right? So I have a buddy who owns 2 investment properties in Missouri, never lived in them, rents them out. They would qualify under this program.
Yes.
Okay. Perfect.
It is owner-occupied primary residence. There aren't any non-occupant co-borrowers allowed in this program, so mom and dad can't co-sign. The credit limits are pretty liberal. 680 score, you can go up to a debt to income of 45. If you have a 700, a 700 score, you can push it up to a 50% debt to income ratio. So kind of how this works, the down payment assistance is due upon sale or refinance. And the way it works is that depending on what the percentage of the down payment assistance program is, the DFA, if you're using a whole 20% of the equity would be due back to the state after the program. But if it's 15%, it's 15%. So it depends on how much you are going to be using. Now you can actually piggyback the borrower's funds and the down payment assistance funds. So the maximum down payment would be 30%, but you can kind of mix and match that any way you choose depending on the borrower's needs.
So a little example would be a house costs $1 million. You're buying a house for $1 million. They have 20% down, and then they add this 10% DFA. So they put 200,000 down. And then DFA adds 10% down. 10 years later, the property is now worth $2 million. Let's just do easy math. And they sell it. So now DFA gets their original 10%, $100,000 back, plus that appreciation of another $100,000. Correct?
Yeah, I'll do an example of how it works, but yeah, that's pretty close to what we're looking at. Their gift funds can also be used in this program, and the borrowers would have to complete the home buyer's education counseling. It's a pretty simple education process to get a certificate. A few other things that we don't know is when you could get in contract on this. The program starts on the 27th, so we're really only a few days away. So a few of these things we just haven't been told yet, and what your actual contract date can be. And the exact cost of the program, we're estimating it's going to be about 2.5% to 3% of the loan amount. And then the final thing is timeframes. And I think on this, we just really need to be able to set the correct expectations because, we move very fast on our end. I'm assuming, this program is going to be very popular and it's a state program and they're probably going to be understaffed. And I think just as long as we kind of set the proper expectations, hopefully They'll go through pretty quickly, but we just want to make sure that we're letting everybody know it may take a while on these programs.
My understanding about, these programs, when it does become available, when it is launched, when it is ready, you got to move fast before they run out of money. So no dragging your heels. So attention, all my friends that I text for all these cool things. And then you just like, oh, well, I'll get to it one day. And then end up not getting to it and not getting this cool program. So yeah, move fast and be proactive and get this, really cool service. Exact cost of the program, we don't know, will likely be 2.5% to 3% of the DFA loan amount. Is that at closing? Is that an annual number? What is that?
It would be at closing. So it would be just as if you had think of it as a second loan that had 2 points cost to it. That's really what it would be at. So at closing is going to be part of the closing cost.
That example that I gave, $1 million purchase price, they give you $100,000. It'll likely be something around $2,500 to $3,000 bucks. As like a little, okay, great.
Moving right along. So there are income limits to this. They're not bad. I mean, San Mateo, San Francisco, Marin, Santa Clara, 300,000 income limit. Some of the other counties you have to be kind of careful with. If you're getting out in the boonies, your income limit drops off quite a bit. So if you happen to be writing an offer up there, just make sure that you're looking at the income limit. Just let us know where they're going, and we could definitely look it up for them.
If folks are pre-approved by you and you kind of get an idea of where they're looking, as a realtor, we stay in touch with you and say, hey, we're writing an offer on this place. You kind of give us hey, don't forget, they qualify here, but not in, Alameda, for instance, or whatever.
Good point. Yeah. Because if they, we're seeing a lot of that, right? People are moving, deciding to move into different counties that they originally didn't start with. So it's possible that could happen. So just FYI. This is kind of the good part. This is where we get down to where it really is going to help people. So in these scenarios, the first scenario is just a 10% down with mortgage insurance, and we're looking at a 1.2 purchase price. So as you can see, that the total payment, including taxes and insurance and MI, is going to be about we'll call it 85. You can kind of see the numbers here. Under the 80, 10, and 10, which would be 10% down, a 10% second loan, you're looking at about 85.20. But then over here, if you look at you're using the program, now you're bumping them up to a 1.4 purchase price. Total monthly payment is less, and the cash flows is about the same.
So we're talking about the number one example is just a basic 10% down with mortgage insurance product. And that's what it is. So your monthly payment. And then the second one is 1.2, 80, 10, 10. So that's 10% down and then a 10% second. So that it creates a savings of $64.31 over the first scenario. And then if they actually bought a higher priced home, their payments would be $439.61 less, with essentially the same exact down payment amount, or like $1,140 more, but their payments are actually lower by $439.61. Is that correct?
Yeah, that's right. And I'll show you how it's broken up. In that scenario, the borrowers are coming in with their own funds, using a down payment assistance loan.
So on this last Dreams for All program example right here, they are basically getting fairly substantially more house for less money.
Yep. Here's the payment breakdown. So this basically just shows, the P&I, estimated property tax, housing insurance, mortgage insurance, and the total. And then this is the same scenario, but with that second. Again, on this second, there's no payments to do. And then this really gets into what it looks like for the borrower 5 years from now, which you can see if we're looking at just the cost of the loan is going to save them over $32,000 in monthly payments. And then we get a little bit deeper. The interest that they aren't paying during that period is another $30,000. So the savings is substantial with a higher priced home over a 5-year period of time. Okay, so here's an example how the equity share would work. So let's just keep it simple, and let's say that we're looking at a 1.2 purchase price with 20% down, and that entire 20% is going to be the down payment assistance, the DFA program. So your first loan is going to be $940. So let's say 5 years from now, they sell the home. And they sell it for 1.4. First thing they got to do is they have to pay back that 140 or 240 back to the state. Their First loan is going to be about 900,000 in 5 years after paying off principal. And then they're going to end up with about 260 equity in the home. 20% of that goes back to the state. So we're talking about 52,000. So the borrower's homeowner's equity is going to be about 208.
So the state government makes some money, homeowner makes some money, bank made 5 years of interest. Everybody's happy.
Yeah, we do jumbo loans, and we do a lot of them. And we have a lot of different investors that will do things that your typical banks and credit unions won't. We can go as low as 660 on credit scores. We can go as high as 49.9 on the DTI. We have programs that don't have a minimum trade line. Most jumbos want at least 3 trade lines. We can go to almost 90% up to 2 million and 85% up to 3 million. And then we also have programs where we aren't going to hit the current borrower for their current housing expense. So they can make that move without having to use a bridge loan or essentially qualify for the next home and move up home. We're really good with condos. We have our own designated condo review department, and they're the best, man. They're awesome. So if you ever have a condo, even ones that, may be in litigation or non-wardable condos or condo hotels or things like that, we've done them in the past, we could definitely do them again. And then we do stuff outside the box. So we've got, different, bank statement programs. We have investment programs where they just do a debt service coverage, which basically they use the income of the investment to qualify. We do flips. We do no ratio programs, bridge loans, and we even have a reverse mortgage department. And that is us. That's our team. And this is the thing we always like to brag about is that we're pretty darn fast, that our average close is 26 days when the industry's 50, close on time about 99% of the time. Customer satisfaction is 97, and our mostly is our purchase business. So, and that's always been the case. It's been purchase business. That is all we have.
What's the best way to contact you?
Email us. My number is 650-766-8500. And Jen, yours is
650-270-4663.
And then mikeandjenteam.com and Mike and Jen at supremelending.com. So the contact info is there, and the contact information is going to be wherever you're watching this video. Great. Thank you so much. And just real quick to summarize. So basically, this program is probably going to be available starting after March 27th at some point. We'll probably get more info on that. We should hit you up to find out the details. The program is an equity share program where basically they're saying, hey, look, we're going to give you 10% or 20% of your purchase price up to a certain amount. And you can go into that in more detail when you talk to folks, but it looks like in that $1 million, $1.2 million, $1.4 million range. And when you sell, they just get to take advantage of some of the profit and appreciation that you get to take advantage of. But it allows you as the home buyer to get more bang for your buck, buy more house, and live in a nice house. And the cost of that is probably going to be somewhere, seems like between 2.5% and 3%. But we'll find out later. And there are income limits and other things to consider as well. But again, those details you guys will provide.
And Joe, I did want to make sure to make it clear that buyers can start applications today. They don't have to wait until March 27th. We'll be able to finish the pre-approval on March 27th when the program rolls out. But you can absolutely start the application and start working out budget, looking at credit and all that good stuff today.
Perfect. That sounds great. Well, thank you guys so much for joining me. I really, really appreciate it.
Okay.
Thank you.
Thanks, Joe.